Have you ever felt like your money isn't stretching as far as it used to? Do you notice that everyday essentials, groceries, gas, housing, seem to cost more and more while your paycheck remains the same? Inflation is a silent thief, eroding the value of your hard-earned cash and making financial security feel like a moving target. And if inflation wasn't enough, economic uncertainty, market crashes, recessions, and job losses adds another layer of risk. Many people assume financial instability is out of their control, but that couldn't be further from the truth. There are proven strategies that can protect your wealth, allowing you to thrive even in the most volatile economic times. In this video, we will reveal practical, actionable methods to safeguard your finances against inflation and economic instability. By the end, you'll know exactly how to protect your purchasing power, grow your wealth, and secure a future where money works for you, not against you. Understanding inflation and economic uncertainty. Inflation is the gradual increase in prices over time, which reduces the purchasing power of money. As inflation rises, the same amount of money buys fewer goods and services. Historically, inflation has averaged around 2 to 3% annually, but periods of economic instability can push it far higher. In extreme cases, hyperinflation can wipe out savings and cause financial devastation. Economic uncertainty, on the other hand, refers to unpredictable financial conditions caused by factors such as recessions, market crashes, job losses, geopolitical tensions, and shifting government policies. These factors create volatility in investments and can make it difficult to maintain financial stability. While these forces may seem daunting, the right financial strategies can shield your wealth from erosion and ensure you remain financially strong, no matter what the economy throws your way. 1. Diversify your investment portfolio. Don't put all your eggs in one basket. One of the best ways to safeguard your finances is through diversification. Investing in multiple asset classes reduces risk and protects your wealth when one sector underperforms. A well-balanced portfolio might include stocks and index funds. Historically, stocks have outpaced inflation over the long term. Investing in a diverse mix of companies or broad market index funds can provide steady growth. Bonds. Government and corporate bonds offer lower risk and can provide stability during market downturns. Inflation-protected bonds adjust for rising prices, making them a solid choice. Real estate. Property values tend to rise with inflation, making real estate an excellent hedge against economic instability. Rental properties also generate passive income. Precious metals, gold and silver. These tangible assets have historically retained value during inflationary periods and economic crises. Cryptocurrency. While highly volatile, digital assets like Bitcoin are sometimes considered a hedge against inflation and currency devaluation. By spreading your investments across these different asset classes, you can reduce risk and ensure financial stability even in turbulent economic times. 2. Invest in inflation-protected securities. Certain financial instruments are designed to counteract inflation by adjusting their value in response to rising prices. Treasury inflation-protected securities, Type ES. These U.S. government-backed bonds increase in value as inflation rises, ensuring that your investment maintains its purchasing power. I-bonds. These bonds also adjust for inflation and provide a secure way to preserve wealth. Dividend-paying stocks. Companies that offer consistent dividend payouts tend to perform well during inflationary periods. Incorporating these into your portfolio ensures that at least part of your investments is directly protected from inflation's impact. 3. Build a strong emergency fund, your financial lifeline. An emergency fund is essential for surviving economic downturns and unexpected financial hardships. Ideally, you should have 6 to 12 months' worth of living expenses saved in a high-yield savings account or money market fund. This fund serves multiple purposes. Cushioning against job loss. If economic conditions worsen, having cash reserves will help you cover expenses without going into debt. Avoiding the need to liquidate investments. During market downturns, selling stocks or assets at a loss can be financially damaging. An emergency fund prevents this, handling rising costs. If inflation spikes, having extra cash on hand ensures you can afford necessities without resorting to high-interest debt. 4. Pay off high-interest debt before inflation makes it worse. High-interest debt, especially credit card balances, personal loans, and payday loans, can quickly spiral out of control during inflationary periods. As the cost of borrowing increases, so do your interest payments, making it harder to stay afloat financially. To avoid this, prioritize paying off high-interest debt first. Use the debt avalanche method, paying off the highest interest debt first to minimize costs. Consider refinancing loans while interest rates are low. Locking in a fixed-rate mortgage or loan now can save you money as inflation rises. Avoid unnecessary borrowing. In uncertain economic conditions, taking on new debt should be done cautiously. Reducing debt ensures that more of your money is working for you, not against you. 5. Invest in tangible assets that hold value. Some physical assets tend to increase in value over time and act as natural hedges against inflation. Real estate, land, and property typically appreciate over the years, often at a rate higher than inflation. Owning rental properties can provide a continuous stream of passive income. Gold and silver, precious metals have been used as stores of value for centuries. During times of economic turmoil, they tend to retain or even increase their worth. Commodities, agricultural products, oil, and other essential goods often rise in price during inflationary periods. Investing in commodities can be another protective strategy. By holding assets that increase in value, you safeguard your wealth against the declining value of cash. 6. Continuously increase your income. Keep up with inflation. Inflation erodes purchasing power, meaning that earning the same salary year after year is essentially taking a pay cut. One of the best ways to protect yourself financially is to increase your income streams. Here's how. Negotiate salary raises. Stay proactive in asking for raises that match or exceed inflation rates. Develop new skills. Learning high-demand skills in industries like tech, healthcare, and finance can open doors to higher-paying jobs. Start side businesses or freelancing. Additional income sources like freelancing, consulting, or online businesses can create financial stability. Invest in passive income sources. Real estate rentals, dividend stocks, and online ventures can generate income without requiring constant work. By continuously growing your income, you maintain and improve your financial position, regardless of inflation. The road to financial security. Inflation and economic uncertainty don't have to dictate your financial future. With the right strategies, diversifying investments, using inflation-protected securities, maintaining an emergency fund, reducing debt, investing in tangible assets, and increasing income, you can stay ahead of inflation and protect your wealth. By taking action now, you control your financial destiny instead of being at the mercy of economic fluctuations. Start implementing these strategies today, and your future self will thank you. If you found this video helpful, make sure to like, subscribe, and share with others who want to take charge of their financial future.